We end today's show with a look at how the consumer loan industry continues to squeeze customers. Last year, the Federal Reserve Board announced new rules for banks to remove unfair credit card practices. And in May of this year, Congress passed the Credit Card Accountability, Responsibility and Disclosure Act of 2009. Both will only become effective next February. But in the meantime, banks have raised interest rates, imposed higher fees, and reduced credit lines on customers before the new rules can take effect. The House voted earlier this month to make the rules effective immediately. Senate Banking Committee Chair Chris Dodd is pushing to freeze interest rates on existing credit card balances until the law takes effect. And this Thursday, the Senate Banking Committee will take up the proposal to create a Consumer Finance Protection Agency. How will all the new rules change the way banks function, and how much can they protect consumers? That's the subject of a joint Frontline New York Times investigation called The Card Game. Longtime investigative journalist and Frontline correspondent Lowell Bergman talked to industry insiders, lobbyists, politicians, and consumer advocates about how to reform the way the consumer loan industry has done business for decades. I'll be joined in a minute by Lowell Bergman, but first, here's an excerpt of his new documentary, The Card Game. Here, Lowell Bergman talks to Nessa Fetus, the vice president of the American Bankers Association, and Shailesh Mehta, the former CEO of Providian Bank. He asked Mehta to look over a solicitation for a credit card from Bank of America.
Open this one for me and tell me what you think. That's from Bank of America. And on the back, it says 0% intro APR.
But there is a asterisk or whatever the mark. So I have to now read that footnote. I will have to remove my glasses to read it. It says, for this, see disclosure summary, insert for details. And I have to find a disclosure summary, which is the one here. So on the outside, it says 0% intro APR. In here, it says that my APR is 11.9, 15.9, or 19.9. Right? And the APR you receive is determined based on your creditworthiness. So I have no idea which one I'm going to get when they approve me.
So disclosure, you say, doesn't work.
I mean, look how much time it takes for both of us to go through this. I think that your average consumer is not going to be able to translate what the real pricing is.
Now, you put out statements like this for Providian?
We did, absolutely.
The complaint that led to this legislation is that the credit card industry was abusing its customers.
Well, the vast majority of cardholders manage their credit well, but there was a group that was confused, and that's what Congress and the press were reacting to.
And those people, how many of them are there? Millions? The confused? I mean, are those the people who are going bankrupt?
Most of the people who end up in bankruptcy or who end up with credit card problems, the underlying problem isn't the credit card. Most customers managed their credit cards well, understood them, but there was a segment that was confused, and they realized that it had to be addressed.
But Senator Dodd and others have said to us, the industry got arrogant. You started using all these practices that created this problem.
Well, once Congress and the regulators identified the problems, they've addressed it, and the industry's moving on.
That was Nessa Fetus, the vice president of the American Bankers Association, talking to Frontline correspondent Lowell Bergman. An excerpt from The Card Game, which airs next Tuesday, November 24th, 9 p.m. Eastern Time on PBS. Award-winning investigative journalist and Frontline correspondent Lowell Bergman joins us now from University of California, Berkeley, where he teaches at the Graduate School of Journalism. We welcome you to Democracy Now! This is a follow-up to your secret history of the credit card. Can you take us from there? I don't think people, well, obviously they don't know it as you talk about the secret history, right through what you're looking at today, Professor Bergman.
Well, I guess my initial interest in this subject area came from many years of reporting on organized crime, and a question that I kept asking various prosecutors. I remember interviewing, in fact, in the first documentary, then Attorney General Eliot Spitzer in New York, and asked him, can you enforce the loan sharking laws in New York when it comes to banks? And he said yes, and off camera his aide told him, no, you can't. In fact, what happened, and it was a series of unintended consequences 30 years ago, is that the lid came off of interest rates in the United States federally for banks. And what that's meant is when you see your credit card bills, some people now have had their rates just arbitrarily changed to 30%. That's way above most state usury laws, those traditional laws that kept interest rates down to a level where people could actually pay them. And actually almost every state in the United States has had these caps up until 30 years ago. And so this began in terms of my trying to understand how this happened. And the results of all of this, and I say it was unintended consequences 30 years ago about what was going on in the economy, is that we had the birth of the modern credit card industry in the United States, something uniquely American, where people could live beyond their means and eventually got so far beyond their means that the whole business, in a sense today, is in danger of collapse. Credit cards, which were the profit center for banks in the United States, are now great centers of losses. And that's why you're experiencing, if you have one, and most people have 5 in their wallet, you're noticing that your credit line is being reduced or your interest rates being raised. That's because of the great losses that are going on as a result of the economic crisis.
Talk about Anita Holliday, a 91-year-old woman in Florida.
Well, people are are opening up their mail and finding out that they may have a credit card balance, and all of a sudden the rate on that balance, the interest rate, which affects your monthly income, has changed. And that's because traditionally, and this will, by the way, the law that was passed and that President Obama signed last May during Memorial Day weekend really doesn't go fully into effect until February. So as a result, the credit card companies, which were already changing their rates and balances, went into full gear and have lifted rates for all kinds of customers. In essence, what they're trying to do is get rid of what they see are potential losses, and they're desperately trying to get as much income as they can. So that's affecting people on fixed incomes. That's affecting any number of people who've been using credit cards for small business purposes. They're self-employed. And so it's costing people more and more money, and the result is people are being pounded in addition to the problems of getting jobs in this very difficult economy.
Can you talk about the legislation now on Capitol Hill, about the heavy lobbying that's going on, the Federal Reserve Board announcing new rules for banks to remove their credit card practices, and in May, Congress passing the Credit Card Accountability, Responsibility, and Disclosure Act of 2009, which won't become effective until, what, next February?
Right. In the documentary, we go through the sort of history, try to reprise some of the history from the prior documentary, and then present you with a situation today. Up until this year, the financial services lobby, which includes the banks in the 8,000 banks in the United States, and particularly the bigger banks, have been able to lobby Congress so as to stop almost any new regulation. That's changed this year because of this sort of upswelling of anger out there of customers as to what was happening to them with their banks. Congress took recommendations that had been made by the Fed, which hadn't done anything for decades related to the industry, and turned them into this law, which President Obama signed. The law, however, is very narrow, and there are plenty of loopholes in that law. And so to make up for that, based upon consumer advocates and various people's proposals, that the regulation of credit cards in particular, but financial consumer lending in general, needed to be centralized in one place. The administration proposed this past summer a new Consumer Financial Protection Agency that would take the powers from the different sort of alphabet soup of agencies that you may have heard the names, like FDIC, OCC, as well as the Federal Reserve, and put them all in one central regulator that would look out for consumers. That's what the Senate Banking Committee is looking at in debate this week and next week, and possibly the committee will be voting on. It's something that the House Financial Services Committee has already voted on and taken out of committee. And the banks are furiously both some banks are trying to, and lobbyists are trying to defeat that act as well, and if they can't do that, water it down.